As the market tries to find its footing, Navitas Semiconductor, ticker NVTS, is currently in a free fall, trading live at 9.01 per share. That is a brutal drop of 85 cents or 8.62% just today, adding to a multi-day slide that has erased significant value and has investors scrambling for answers. The stock is plumbing its morning lows, with volume surging as sellers overwhelm buyers. Now, many investors have been holding Navitas based on a powerful forward-looking narrative that this company is a pure play on the next generation of power semiconductors, the gallium nitride and silicon carbide chips that will run everything from artificial intelligence data centers to electric vehicles. The expectation was that this was a high-growth story just getting started. But the reality hitting the tape today is that this growth story has just hit a concrete wall. The 8.62% collapse you are seeing right now is not a random market dip. It is the culmination of a perfect storm of negative catalysts all hitting at once, confirming the market's deepest fears about the company's immediate future. The pressure on Navitas today is a direct and delayed reaction to its third-quarter earnings report released just a few days ago on November 3rd. The numbers were not just a miss, they were a complete disappointment to a market priced for perfection. The company reported a loss of 9 cents per share, significantly worse than the 5-cent loss analysts had forecast. But the real damage came from revenue. The street was looking for $10.79 million, and Navitas delivered only $10.1 million. In a high-growth stock, a revenue miss of that magnitude is a major red flag. But what turned this miss into a full-blown crisis for the stock was the guidance. For the upcoming fourth quarter, management guided revenue to a stunningly low $7.0 million, plus or minus $250,000. To put this in perspective, the company just did $10.1 million in Q3 and $14.5 million in Q2. This is not a slowdown. It is a sequential collapse in the business, and management themselves are now calling Q4 the revenue bottom. This guidance effectively told investors that any hope for a quick recovery is gone, and the pain is just beginning. As if that catastrophic guidance was not enough, the news flow got worse. Just yesterday, November 5th, a filing revealed that the company's own chief financial officer, Todd Glickman, sold 96,313 shares for a total of over $1 million. While the company stated the sale was planned and executed to cover tax withholding obligations from vesting stock units, the timing is simply terrible. Seeing a C-suite executive unload $1 million worth of stock right after a disastrous earnings report and a guidance cut sends a chilling message to the market, regardless of the stated reason. It shatters confidence. This was then compounded by a wave of analyst actions this morning. Rosenblatt Securities, for example, slashed its price target down to $8, maintaining a neutral rating. This cascade of an earnings miss, a guidance collapse, a large insider sale, and analyst downgrades is what is fueling the 8.62% decline you see live on your screen. The market expectation of a smooth ramp-up has met the harsh reality of a painful, uncertain, and costly business pivot. This pivot is what management is calling Navitas 2.0. For years, the bull case for Navitas was built on its GaN-fast power ICs, which were rapidly taking over the mobile fast charger market for companies like Samsung and Xiaomi. This was Navitas 1.0. The new strategy, Navitas 2.0, is a deliberate and abrupt decision to abandon this low-power, lower-profit China-centric mobile business and go all in on high-power, high-margin markets. These are the big leagues: AI data centers, solar and energy infrastructure, and industrial applications. On paper, this is the right move. They even announced a major win, being named a power semiconductor partner for NVIDIA's next-generation 800-volt DC AI Actory factory architecture. This is a massive validation of their technology. They are also sampling new extremely high-voltage silicon carbide modules for energy grid customers. The problem is that these new markets, particularly AI, are not expected to contribute significant revenue until 2027. Management is asking investors who bought a growth stock to sit patiently through a revenue collapse and wait over a year until 2026 for sequential growth to even begin again. This is where the short seller thesis has found its teeth, and it is crucial for every investor to understand this side of the trade. Navitas is one of the most heavily shorted stocks on the market. Depending on the data source, the short interest as a percent of the free float is sitting at an alarmingly high 24 to 30%. For comparison, the average for its peer group is closer to 10%. This means for every 4 shares available to trade, 1 is sold short. The bear thesis, which this earnings report just validated, is simple. Navitas is a company with a sky-high valuation built on a story of growth that is now facing a complete collapse in its core revenue stream. The shorts are betting that the AI story is too far in the future and that the company will burn through its cash before that new revenue ever offsets the old. They see the 53% year-over-year revenue drop and the $7 million Q4 guidance and believe the stock, even at $9, is still massively overvalued relative to its actual earning power. Now, many retail investors see high short interest and immediately think short squeeze. This is where you must be careful and look at the data correctly. To get a squeeze, you need a catalyst, but you also need shares to be difficult or expensive to borrow. Let's look at the actionable data. You can find short interest data on the official NASDAQ website, which is updated twice a month, or use platforms like Fintel or Ortex for more frequent estimates. But the key metric to watch is the borrow fee rate. This is the interest rate short sellers must pay to borrow the stock. In a classic squeeze setup, this rate explodes to 50%, 100%, or even 300%. For Navitas, the borrow fee rate is currently less than 1%. This is critically important. It means that despite the high short interest, shares are abundant and cheap to borrow. This is not a crowded trade that is hard to get into. This is large institutional money placing a convicted, well-funded bet that the stock is going lower. This is not a signal of an imminent squeeze. It is a signal of genuine, deep-seated bearish conviction. The short sellers are not trapped. They are winning. What's your take on the 25% short interest? Is this smart money correctly identifying the valuation problem, or is it an over-exaggeration of the pivot's pain? This entire situation is made more complex by the company's supply chain. A recent 10Q filing revealed a significant risk. TSMC, a primary supplier for its GaN products, apparently plans to cease its GaN production in July 2027. Navitas stated it is in the process of qualifying a new partner, PowerChip, with mass production targeted for the first half of 2026. This adds another layer of execution risk to an already incredibly difficult pivot. They are not just changing their entire customer base and market, they are also in the process of migrating their core supply chain. This is an enormous undertaking for a small company. The one saving grace in all this is the balance sheet. Navitas has $150 million in cash and, crucially, no debt. This gives them a runway. At their current non-GAAP operating loss of about $11.5 million per quarter, they have enough cash to fund this transition for a long time. The entire bet on Navitas is no longer about Q3 or Q4. It is a bet that this $150 million is enough to bridge the company over the valley of collapsing revenue to the promised land of AI and silicon carbide revenue in 2027. So what exactly does Navitas do? The company's technology is genuinely impressive. It designs next-generation power semiconductors. Its gallium nitride, or GaN chips, allow for power supplies that are smaller, more efficient, and run cooler than old silicon-based chips. This is why they dominated the fast charger market for companies like Samsung and Xiaomi. This was Navitas 1.0. The new strategy, Navitas 2.0, is a deliberate and abrupt decision to abandon this low-power, lower-profit China-centric mobile business and go all in on high-power, high-margin markets. These are the big leagues: AI data centers, solar and energy infrastructure, and industrial applications. On paper, this is the right move. They even announced a major win, being named a power semiconductor partner for NVIDIA's next-generation 800-volt DC AI factory architecture. This is a massive validation of their technology. They are also sampling new, extremely high-voltage silicon carbide modules for energy grid customers. The problem is that these new markets, particularly AI, are not expected to contribute significant revenue until 2027. Management is asking investors who bought a growth stock to sit patiently through a revenue collapse and wait over a year until 2026 for sequential growth to even begin again. This is where the short seller thesis has found its teeth, and it is crucial for every investor to understand this side of the trade. Navitas is one of the most heavily shorted stocks on the market.